In this video, we're going to continue talking about different ways of determining value for a company. So the first one here looks at what's referred to as the total payout model. And then we'll move to something referred to as free cash flow models. So let's first talk about repurchases. So the idea of the total payout model says that we should incorporate all of the potential distributions when we think about valuing the company. Well, there's two distributions to owners. The first one is obviously dividends. We can pay out dividends. But the one that we kind of don't think about as a distribution is share repurchases. But they are, in essence, the final distribution to some owners, because we're going to buy back their stock. So the idea here is that by repurchasing stock, the firm decreases the number of shares outstanding. And since that increases earnings per share and dividends per share, that's going to have an impact on value. So the model then just says we want to find the present value of future total dividends and repurchases. Divide that by the number of shares outstanding. Now, this is going to value all of the company's equity rather than a single share, right? So in this case, we want to look at total dividends paid, not dividend per share, and share repurchases. And we're going to use the growth rate of earnings rather than earnings per share when we're forecasting the growth of these payouts. So let's see how we apply this model. There is a worksheet, it's called Total Payout Model. Again, here's the variables we need. How many shares were repurchased this past year? Well, in this case, for Coors, they didn't repurchase any this year. You can see it's got a 0 here. Let's go down here. The number of shares, the dividends actually paid out, and the estimated earnings per share growth. These variables, including the shares repurchased, are all found in Yahoo Finance for the companies. And you should have gathered this information through projects, etc. Now, how do we find the weighted average cost of capital? There is a website that's called that'swacc.com. Sometimes this model, the company is found and you can identify what they say the weighted average cost of capital is. If that doesn't work, you can also just Google for WACC for, in this case, Molson Coors or TAP. And in this case, that's what I ultimately did. And it said that it was 8.83%. We plug that information into the model, right? Dividends paid out, repurchases. Here's our weighted average cost of capital. We'll actually talk about this in future videos. This is the average cost of gathering funds, including stocks and bonds. Here's the number of shares, the growth rate of earnings. So the value that they give us for Coors is $22.77. Yeah, it's a very simple model. It just incorporates, again, a different version of the company, right? A different version of the value of the stock itself. Now we're going to move on to something referred to as the discounted free cash flow model. So the first thing we want to talk about is, what is this thing called enterprise value? The enterprise value can be interpreted as the net cost of the stock, the firm's equity, take the cash of the company, and pay off all of the debt. So in the end, the enterprise value represents the unlevered value of the business once you have completed this transaction. So you buy all the stock, take the cash of the company and you also buy back all the debt of the company. This would then, or pay off all the debt. This would create this unlevered value of the company. So the first formula we have here that we need is something referred to then as free cash flow. What is free cash flow? Essentially, it's all the cash that's available after we've paid off everything else to pay both debt holders and equity holders their expected cash flows that they expect to get. So we need, first of all, the earnings, the unlevered net income, EBIT times 1 minus the corporate tax rate. We add to that depreciation. We then subtract the capital expenditures for the year, and we also subtract the changes in net working capital. So we could be subtracting increases, or we could be subtracting decreases, right? So it could be, if it's a decrease in net working capital, it would be a negative, a minus a negative value, which then obviously we would be adding to the free cash flow. So how the valuation works, it's the present value of the free cash flow, right? And the value of the price of the company is the value, right? The enterprise value plus cash minus debt divided by shares outstanding. Since we're discounting the cash flows to both equity and debt holders, right, the free cash flow has to be discounted at the firm's weighted average cost of capital. And again, we'll talk about that in future videos. But if the firm has no debt, then that average cost of capital is equal to the cost of equity. So let's talk about how we incorporate or implement this model. The value of the company is the present value of all of its future cash flows. In this case, they're free cash flows plus the future value of the company. Again, since we're going to try to do this model, we're going to assume what? An infinite life, and we're also going to assume a constant growth rate of free cash flow. That is absolutely not a really good assumption to make, but we have to make it to get the model to work. So the value of the company, V sub n, then is this free cash flow next year divided by the weighted average cost of capital minus the future growth rate of free cash flows. This should be familiar because it is almost identical to the dividend cash flow model. Now, what we're going to end up with here is not a value per share. We're going to end up with a value of the company, right? So the value of the company is the value of the stock plus the value of the dividends minus the free cash flow. This is the enterprise value of the company. V sub S, subtract the debt, add the cash to the value of the firm. That gives you what the value of the equity is. And I don't know if that's going a little bit too fast, but we're looking at, again, this is a different kind of a model, if you will. It's looking at a different way of valuing the cash flows of the company. So let's plug this into an example. If you estimate the growth of free cash flow to be 7%, $700,000 is the most recent, and the firm's weighted average cost of capital is 13%. What is the firm's value? If we plug that into our formula, we'll find that the value of the formula, the company, is $12.5 million essentially dollars. Now, this company has $1 million in cash. The market value of its debt is $7.5 million, and they have 100,000 shares. So what is the value of equity? Well, the value, V sub S, is the value of the firm minus the value of the debt plus cash. 12.5 minus 7.5 plus 1 gives us roughly here $5.9 million is the value of the company's equity. That's what you would be willing to pay for the entire ball of wax, right? The entire stock population for this particular company. So let's see how this would fit in a model, right? An Excel model. This should look a little similar to the dividend constant growth model. Weighted average cost of capital, again, we said it's 13%. The growth rate 7. The most recent free cash flow was 7. So we're predicting future cash flows of $749,000. And when you plug that in, that's our 12.5. $7.5 million for the market value of debt, $1 million for cash, 5.98. So it's the same number we got with the formula before. Divided by the number of shares, we should have a share of stock here of roughly $59.83. Can we apply this to a real company? And of course, I did. Again, this information all comes from Yahoo Finance. Cash, total debt, the number of shares. Again, you can find the growth of free cash flow. You can estimate next year's free cash flow. Sometimes in Yahoo Finance, you can actually find that number. And here is the free cash flow for the last several years of TAP. Now, these numbers, free cash flow numbers, can either come from your analysis, right? Some type of a ratio analysis, but frequently in Yahoo Finance, they only give you the most recent free cash flow. So you may have to do some calculations for these numbers. Now we just plug it. Here it is. It's the free cash flow valuation model. Here we have our numbers. 8.83 we said is the weighted average cost of capital. So we need to have the growth rate, right? So we're saying the growth rate's 3.7. We have estimated, again, I did this on purpose so you can remember about this. If you're given what you think next year's free cash flow is, you can just type it in here. The market value of debt for the company, cash that's available. So the market value of common here is $11,872. Now this is in millions, so that's obviously very big. Divide that by the number of shares, 187. So the value per share for Coors is $63.49. Again, we can do this for each and every company that you can think of out there. So it's a pretty nice model. If you remember in some previous videos, we talked about, well, what if the company doesn't pay dividends? Well, then those dividend models, right? The total payout model is not going to work. The dividend growth model is not going to work because it doesn't have dividends. This might be the one model that we have that will work, at least using cash flows for finding value. So what is the connection to this free cash flow model and capital budgeting, right? So essentially what this tells us is we can interpret the enterprise value as the total net present value that the company will earn from continuing its existing projects and initiating new ones, because we're thinking about the future. So the net present value of any individual project represents its contribution to the firm's enterprise value. So to maximize the firm's share price, we should accept projects that have positive net present value. So just in conclusion of these cash flow kinds of models, let's think about what they have told us, right? The dividend model gives us stock price. The total payout model gives us equity value, and the free cash flow model gives or determines enterprise value. So all of these can ultimately kind of converted into a stock price, but they all come from different corners, if you will, right? Different data, different theory, different kinds of cash flows. So in the end, what we might want to do is have a table that represents all of these different estimations of value to see, are they consistent? Are there things that are a little bit out of whack? What should we do with buying this stock? We probably don't ever want to rely on one model to determine a financial decision moving forward. So that's the end of this video. I look forward to seeing you in the next one.